This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 12 of Value Investing. In this episode, I'm going to talk about a topic called owner earnings, which is detailed by Warren Buffett in his 1986 shareholder letter. So this is a very crucial topic for you to understand if you're trying to calculate an intrinsic value of a company that you're interested in. In the letter, Warren Buffett explained in detail why it is important for you to take into account owner earnings instead of looking at just purely accounting earnings number from the company's income statement. And I'm going to explain to you how you can calculate owner's earning. In the later episode, I may be able to cover how you can calculate intrinsic value of a company using owner earnings. Additionally, I want to give you a heads up that this episode contains a lot of terms related to accounting. However, if you understand the basics of accounting, you should be able to follow quite easily. Before we get into the details, if you haven't already done so, please subscribe to my channel, and 5-star review always goes a long way. Without further ado, why don't we get started? Owner earnings is a valuation method detailed by Warren Buffett in 1986. Warren Buffett stated that the value of a company is simply the total of net cash flows expected to occur over the life of the business minus any reinvestment of earnings. So this is high-level definition of owner earnings, but I'm going to get into the details during this podcast episode, how you can calculate this one. And also, I'll put the note in the podcast episode description box. Warren Buffett, in his 1986 shareholder letter, provided a good example of why it is important to consider owner earnings. The example was Berkshire's acquisition on Scott Feather, which is the company that manufactures a lot of machines, in 1986. Warren Buffett explained how Berkshire's acquisition changed Scott Feather's accounting numbers, especially related to earnings, completely before and after acquisition. So let me just try to explain what happened after the acquisition. Berkshire Hathaway purchased Scott Feather in 1986 for about $400 million, which represents a premium of $142 million on top of the company's book value, $172 million. So because of this premium, the earnings of Scott Feather Company changed dramatically. So let me just walk you through what happened from the balance sheet perspective, and let me move on to the income statement and how balance sheet change impacted income statement earnings. Whenever you have acquisition, acquiring company usually pays premium, which represents additional money that acquiring company pays in addition to the book value. So in the case of Berkshire Hathaway, as I mentioned, Berkshire Hathaway paid $400 million. $400 million is $142 million above Pfizer's book value on the balance sheet. So that's called premium. $142 million is the premium. Then what happens is that acquiring company has to allocate this premium to somewhere on the balance sheet. So Berkshire Hathaway had to do the same thing. The first thing the Berkshire Hathaway had to do is to adjust carrying value of current assets and liabilities to current values. If you look at the top items on the balance sheet, on the asset side, cash and account receivables are routinely carried at current value, so there's no adjustments are needed for these two items. But if you look at inventories, you can adjust inventories to the current value, and that's what Warren Buffett did for Berkshire Hathaway. And in the case of Scott Feather acquisition, so the inventory was adjusted from $77 million to $114 million, which represents $37 million up for inventories. So this is current valuation adjustments for inventory. Berkshire Hathaway did the same thing for fixed assets, which are shown on the balance sheet as property, plant, and equipment. Berkshire Hathaway adjusted the value of fixed assets from $80 million to $148 million in order to match to the current valuation. On the liability side, Berkshire Hathaway also adjusted deferred tax liability, and it brought down this liability item by $13 million. And Warren Buffett explained in his shareholder letter, he doesn't know what the heck this item is. So usually whenever you see tax items on the balance sheet or tax items on the income statement, it is very complicated subject, so you don't want to go there. But these are the items that tax accountants know detail. And you may not need to know all the details as an investor. So for that reason, I'm going to skip this item. So after adjusting current assets and liabilities to the current valuation, still Berkshire Hathaway had $24 million left to allocate somewhere on the balance sheet. What happens is that this unallocated amount, $24 million, is recorded as goodwill. So this is what happens on the balance sheet side when acquiring company pays a premium. So premium has to be allocated to somewhere on the balance sheet, and the acquiring company can bring up the value of inventory or fixed assets to the current valuation, because they are usually recorded on the balance sheet at historical cost. They can bring up this valuation to the current valuation. But if the premium still cannot be allocated in full to these items, then the whatever's left is going to be recorded as goodwill. That's what happens on the balance sheet side. So why don't we move on to the income statement side, because this is what's important for investors' valuation of the company. So the bottom line here is that Scott Feather Company's net income before the acquisition was $40 million annual income. And after the acquisition, because of accounting change, the annual income, net income, went down to $28 million, almost 30% drop. So what happened exactly? This company is exactly the same company. The economic value of the company has not changed, but due to accounting rules changed, the company's net income dropped 30%. So let's go over the details of what happened on the asset side could impact income statement side in a negative manner. We talked about adjustments of inventory and fixed assets. So when we adjust the fixed assets up by $68 million, that actually translates into depreciation cost of this fixed asset up by $5 million on the income statement side. There's item on income statement side called depreciation of plant and equipment, and that cost has gone up by $5 million as a result of adjusted fixed asset valuation. And we allocated $24 million left for goodwill on the balance sheet side. At the time of acquisition by Berkshire Hathaway, the accounting rule mandated the companies to amortize goodwill over the course of a certain number of years, let's say 30 years. the companies, by accounting rule, had to amortize whatever goodwill that they have. But right now, the accounting rule changed, so the companies do not have to amortize the goodwill. But back then, that was the rule. So that cost Berkshire Hathaway on the income statement side $6 million for that year. And there was item called non-cash inventory cost, $5 million. This is also as a result of acquisition. And there's another non-cash item, $10 million for deferred tax asset change. So in total, the net income before acquisition was $40 million. And after acquisition, it was $28 million for exactly the same year for exactly the same company. Now you may have a lot of questions regarding net income valuation change due to accounting rules. What does all this mean for owners? Did the shareholders of Berkshire Hathaway buy a business that earned $40 million, or did they buy one earning only $28 million? Were those $11 million of new charge a real economic cost to Berkshire Hathaway shareholders? Should investors pay more for the stock of the company before the acquisition than the company after the acquisition? If business is worth some given multiple of earnings, which is what a lot of people are using as a P/E ratio, was Scott Pfizer worth considerably more the day before the acquisition than it was worth the following day? Warren Buffett was trying to answer to these questions, and he said, quote, "If we think through these questions, we can gain some insights about what may be called owner earnings." Owner earnings can be calculated mathematically as follows. First, you look at reported earning plus depreciation, depletion, amortization, and certain other non-cash charges minus average annual amount of capitalized expenditure for plant and equipment. And this is the calculation formula that Warren Buffett used to derive owner earnings. So instead of just simply memorizing this formula, I think it's important for you to understand why he used this formula instead of just reported earnings. So Warren Buffett is simply making adjustments to reported earnings. So there are three components to this formula. The first thing Warren Buffett did was take reported earnings as a basis. So he's going to make adjustments to that. And the second component is adding back all non-cash items such as depreciation, depletion, amortization, and other non-cash charges, because these are not actual cash that's coming out of your pocket. And the last item he subtracted was actual cash coming out of your pocket, which is capital expenditure on plant and equipment and etc. So he's focusing on cash flow instead of focusing on earnings on the income statement. And I think which makes sense, perfect sense. And if you are familiar with accounting concepts, then you would immediately know that Warren Buffett is trying to construct cash flow statements here. Back then, Warren Buffett wrote his letter in 1986. Cash flow statement was not a requirement for a public company to publish. But what's quite remarkable is that after this letter came out, in 1987, the Financial Accounting Standard Board mandated all the firms to provide cash flow statements. So when Warren Buffett published his letter, people had to manually calculate owner earnings in order to know exact intrinsic value of the company. But since 1987, all the companies were required to publish cash flow statements, so you don't have to do the work, manual work, in order to calculate owner earnings. So how can you do that given that you have this cash flow statement available for you as an investor? If you look at the cash flow statement, there are 3 sections. The first section is called operating activities. Second section, investing activities. Finally, financial activities. For your owner earnings calculation, you only need operating activities and investing activities. So let me just walk you through how you can calculate owner earning in a very simple manner. You just take total cash flow from operating activities, which is basically what Warren Buffett did for the first 2 components. You take reported earnings and add it back all non-cash items. After that, you subtract capital expenditure in the section of investing activities. But what's important here is that, as Warren Buffett mentioned, it's not just taking capital expenditure for that year, because capital expenditure can vary quite significantly, unlike depreciation cost. So you have to calculate average capital expenditure over time in order to smooth out all the fluctuations, volatilities in the calculation. You may have to apply some judgment here, so it's not black and white. You may have to guess how much capital expenditure be required for your business. So in that sense, owner earnings are not exact measure. Now that we talked about and learned how to calculate owner earnings, let's move into the next topic, which is the takeaways that I got from this annual letter. The first takeaway is you'll be able to understand which company is in capital intensive industry and which one is not. You probably have some intuition about which company requires a lot of capital. For example, airlines, cruise lines, railroads, auto companies, oil companies. These are the companies that are in capital intensive industry. What does that mean? It means that they require a lot of capital expenditure. So now you know how to calculate owner earnings. You should be able to understand why it is so powerful compared to just simply looking at reported earnings. The reported earnings can be misleading if the depreciation cost is a lot lower than capital expenditure. Usually that's the case for a lot of these companies in capital intensive industry, because these companies are required to invest a lot of capital back to their business in order to just maintain their operations. Look at airlines. They have a lot of airplanes to maintain, and it's going to cost a lot in order to just maintain the airplanes in a good, safe mode. And look at railroads, look at oil companies. These are the companies have huge equipments and buildings that require a lot of capital infusion. So by calculating owner earnings, you should be able to derive actual earning power of this company. On the other side, look at other technology companies like eBay, Google, consulting companies. These companies do not require a lot of capital by definition because they don't have a lot of assets. They don't have a lot of physical assets that require a lot of capital invested back into the business. So if you calculate owner earnings for these asset-light businesses, you're going to have higher owner earnings. The second takeaway is the fact that a lot of investment bankers are using EBITDA in order to justify the price of acquisition. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This is the metric that Warren Buffett hates. Whenever he sees this metric from investment bankers or some other people, he thinks that this metric is very deceiving to the investors. Warren Buffett said, quote, "Why then are cash flow numbers so popular today? In answer, we confess our cynicism. We believe these numbers frequently used by marketers of businesses and securities in an attempt to justify unjustifiable." So what Warren Buffett is saying here is that the use of EBITDA is just taking into account the first two components of owner earnings formula, so which is reported earning plus non-cash items. But what they don't do when they calculate EBITDA is subtracting capital expenditure. These are the real expenditure that business has to incur in order to maintain their business. That's just what we just discussed. So that's not what they do when they just use EBITDA number in order to justify high acquisition price. Third takeaway that I want to mention is that cash flow numbers on the cash flow statement are not easily manipulated by the management teams. They are real cash out and cash in, so you should feel confident about these numbers compared to numbers on the income statement. Because if you look at a lot of numbers on the income statements, other than revenue, a lot of these numbers are based on management's judgment. And even though you trust management, in some cases they are not truly representative of economic cost to the company. But if you look at cash flow statement, these numbers are not easily manipulated by the company or management team, because these are actual cash coming in and coming out. So those are the three takeaways that I wanted to mention before I end this episode. Today, we talked about how you can calculate owner earnings and why it is so important for you to understand this concept, and how you can derive this number very easily from cash flow statements these days. Once you calculate this owner earnings, the next item is to translate this into intrinsic value, which I'm going to discuss in the future episode. Okay, so that's it for today's episode. Hopefully you learned quite a lot about owner earnings and you can apply this concept to your next investment ideas. If you haven't already done so, please subscribe to my channel, and 5-star review always goes a long way. Thank you very much and see you next time.